Hello, my name's Mark Helm, and I'm the author of Creating Wealth Through Self-Storage. And let's talk about investing in self-storage today. So you've made the decision that you want to invest some money in self-storage. You don't necessarily want to run the projects. You don't want to be the person at the facility. You don't want to manage the manager or hire people, but yet you still want to invest in self-storage. You get the benefits that self-storage offers. Now, if you're not exactly sure what those benefits are, the previous episode that we did, episode 173 at creatingwealththroughselfstorage.com, talks about specifically the 5 things I think investors need to know today before investing in the self-storage world. But you've made the decision, yes, I want to be in self-storage, but I don't want to run or manage anything. What's the best way to invest in the world of self-storage? Well, let's talk about that today. I basically see 2 primary ways of investing in self-storage, and then inside those 2 ways, there's many variables. But let's talk about them. REITs are a real good way to invest in self-storage today. What a REIT is a real estate investment trust. And typically these are companies that specialize in a particular product type. There's self-storage REITs, there's retail REITs, there's apartment REITs, there's even prison REITs. And these are companies that own and operate a specific asset class or type of investment real estate. Now, the benefits of investing with REITs are, one, at least the publicly traded ones, and most of the larger non-publicly traded REITs are usually very good at what they do. They're good at acquiring, they're good at operating. And in today's world, how REITs operate their business compared to the average smaller mom and pop type storage facility, and don't fool yourself, it is still a very mom and pop industry. How the larger institutional players operate their business is becoming vastly different than how the smaller players do. There's very sophisticated software out there that helps the REITs make informed operational and pricing decisions. Before making an acquisition, they can peer into a sub-market and know the supply and demand of that sub-market. And as they're running projects, they literally, almost in live time, can see what's going on in the sub-market for each one of their properties. Now, that type of software and sophistication is available to the smaller investors. We use that, for example. But most small investors in the self-storage space, at least today, are not operating at that level and are not inclined to operate at that level. So when you invest with the REIT, you're investing in a company that typically is a very good operator. Now, I am not a tax expert, I am not a securities expert, and I'm not a legal expert at all. In any investment decision, make sure you seek competent accounting advice and legal advice. But one of the main differences I see between investing in a REIT and some of the other options that are available is that when you invest in a REIT, what you're doing is you're buying the stock of that company. You're not investing in the facilities. You're buying the stock of the company that owns the facilities. Now, to become a REIT, to operate as a REIT, the main benefit is REITs are not taxed at the corporate level. What is profits, what the IRS defines as profits, are passed through to the stockholders, and then the stockholders pay tax according to their own tax rates. So by being organized as a REIT, REITs are able to avoid what many companies have, which is double taxation. Taxation at the corporate level, then once the profits are passed through, taxation again at the level of the investor. The other thing about the REITs is they are required to distribute 90% of what the distributable profits are. Now, it's a very complicated and exacting calculation to determine what taxable profits are, but as a REIT, they have to distribute 90% of them. One of the main benefits I see in investing in the REITs, especially the publicly traded ones, is the liquidity of your investment. Again, you're buying stock. It's like buying Apple stock. It's like buying GM stock. You can sell the stock through your brokers or on the NASDAQ and Dow, and typically it's a very liquid investment. Now, some of the private REITs, the non-publicly traded REITs, may not be as liquid. Each one of them has their own liquidity standards. For example, some of them, one I was looking at the other day, will buy back up to 5% of their stocks per year. So if you own stock in that private REIT and you want to sell it, you've either got to find the buyer on your own, or the company will buy up to 5% of the total outstanding shares per year. So each one of the private REITs has their own liquidity standards that you've got to go through, but at least the publicly traded ones tend to be very liquid. One of the downsides is it's stock. When you own real estate has its own taxation rules and regulations, and a lot of the benefits that real estate offers the investor are not necessarily experienced at the level of owning stock. Now, again, I'm not a tax expert. Seek competent advice. But one of the downsides I see is much of the tax benefits that real estate offers cannot be experienced by owning stock in REITs. Now, how well have REITs performed? Well, in 2017, the average REIT generated a 3.74% return. Now, that's been the lowest return for a number of years. And so far in 2018, up through the end of July, which is when this particular video was recorded, end of July 2018, the average return so far has been 7.43%. If you decide to explore investing in REITs, there is a lot of information on the internet at your fingertips that's available for you. A real good source of information on REITs is NAREIT, N-A-R-R-E-I-T, NAREIT.com. This has information on both public and private REITs, and it's a good source of just raw data. Again, do your homework, and REITs may be a real good way for you to invest depending on what your investment goals are. The next main way I see to invest in self-storage and not be the owner-operator or buying the facilities yourself is to invest in private placements. Now, there's all types of acquisition, private placement, self-storage LLCs that are out there to invest in. Now, typically, having created a number myself and consulted and coached and worked with people who create their own, generally what I see is the structure is an LLC. In other words, much like the REITs, the LLC is not taxed. They're set up as a partnership, and the profits and losses pass straight through to the investors in the form of a K-1. Typically, these LLCs have at least two classes of ownership. One is for the organizers, the sponsors, the common members. These are the people who put the deals together, manage the facilities in many cases, or manage the companies that manage the facilities, find the deals, put them under contract, and do all of the work to create the LLC and to manage it ongoingly. And then there's the investors. Sometimes there's different classes of investors. In today's world, to get above market returns, and I call it above market return above what the Dow and what the NASDAQ are offering, typically bank financing or some type of financing needs to be on these facilities that are acquired. If we're offering a 8, 10, 12% preferred return to the investors, we've got to keep our cost of capital about 8% or less to generate those type of returns in today's market. So that means for many of these private placements, a large portion of the acquisition needs to be done with bank financing. 4.5%, 5.5%, 6% money. When you blend that cost of capital with the preferred return cost of capital, you're getting anywhere from 7 on the low end to maybe 9% cost of capital on the high end. Typically, on the projects and the private placements, I'm seeing no investor is ever on the debt. If there's recourse on the debt, is provided by the sponsors or some other entity. And very often there's non-recourse debt put on either initially or at some part of the process. Now, the benefits of this type of investment, the private placement for the investor, is one, they literally own the company that owns the real estate. So all of the tax benefits that real estate offer is passed straight through to the investor. So depreciation, straight through to the investor. Interest write-off, operating expense write-off are all passed through. And real estate, for whatever reason, it's evolved with some of the best tax benefits I've seen of any type of investment. Now, again, I am not an expert. Don't count on and rely on what I'm saying here. Take what I'm saying and check it out with your investment counselor. Seek legal, competent investment advice from accountants, brokers, and lawyers. So one of the main benefits is the ability to take advantage of the tax benefits. A huge tax benefit that I'm still shocked we can do is cost segregation. And what that is the IRS allows basically a form of accelerated depreciation if a very specific type of cost segregation report is generated. You don't generate those. Your accountant will, and there's companies that will organize engineers to do these reports. And the main concept behind cost segregation is there are many parts of a self-storage facility or any commercial real estate that should be depreciated faster than the 39 years straight line depreciation. In other words, the light fixture may have a 7-year lifespan, and the wiring in the light fixture may have a 10-year lifespan, and the gate may have a 5-year lifespan. And a cost segregation report breaks out all the components of the facility and gives them their own depreciation time period based on the guidelines the IRS has created. And what this does is it allows a much faster ability to depreciate in the first few years of ownership than straight line depreciation even offers. And for most private placements, it is the investors that benefit from that. Why? Because usually their money is invested in the deal in the first few years of the life of that cost segregation report. So they're benefiting highly, in most cases, from that accelerated depreciation schedule. So that's the type of benefit I don't necessarily see in the REITs that you get with the private placements. Again, seek competent investment advice. The downside is typically your money is not liquid. Your money is invested for a certain time period, 3 to 7 to 10 year investment horizon for your money to be in. Always look at the track record, whether it's a REIT or a private placement, of the organizers, of the people putting the deal together. Look at the track record, see what other types of investments they have created and what the success has been for them. Talk to other investors who have invested in those private placements. You always want to be vetting the sponsors who are organizing the private placement. Now, it doesn't mean that they have to have necessarily a successful track record in self-storage. This could be the first self-storage project that the sponsor's done. And typically, you would be able to command a higher return because this is the first one. When we first got going, we had to offer a much higher preferred return than we're able to offer today. Why? Well, because our track record has been successful and their perceived risk occurs less to them because of the track record. That's just how the market is today. So in conclusion, there are two primary ways that I see to invest in self-storage without actually buying the facilities and running them or managing them yourself. Invest with REIT type entities or invest in private placements. Each has their own list of benefits and downsides. The REITs are typically run very well, have a good track record, and tend to be more liquid. The private placements typically are able to pass through the tax benefits of owning real estate, and they will generate usually above market returns. But whatever you do, if you want to invest in self-storage. It is by far the best asset class to invest in I know of. It is the lowest foreclosed on asset class. Again, for more information on what you should know about self-storage, look at episode 173 at creatingwealththroughselfstorage.com. We go into detail of what those benefits and risk are of self-storage in today's market. But for the investor, I don't see a better asset class to invest in. So thank you very much. My name's Mark Helm. I'm the author of Creating Wealth Through Self-Storage, and I hope someday to meet you. Thanks a lot.